The stock market set a new record high on Friday. The S&P 500 closed at 7,230. The Nasdaq hit 25,000. The financial press celebrated the best monthly performance since 2020. Warren Buffett's annual meeting drew tens of thousands of investors to Omaha. The official narrative of the American economy in the first week of May 2026 is one of resilience, recovery, and record-setting optimism. And then there is the other narrative, the one that does not appear on the front pages because it does not happen in a single dramatic moment. It happens in the quiet routine of millions of ordinary American families who are not at Berkshire Hathaway's annual meeting, who are not watching S&P 500 records, who are not discussing CAPE ratios or repo market dynamics or FOMC descents. They are at their kitchen tables, on their phones, at the gas station that is now charging above $4.50 per gallon, making the specific and increasingly desperate financial calculations that the data says 54% of all Americans are making right now. 54% having reported that their financial situation is worse than a year ago, the highest reading on record. They are not emptying their accounts in panic. They are doing something more alarming than panic. They are emptying them in quiet, systematic necessity. And this video is going to show you exactly who those people are, exactly what the data says they are doing with their money, and exactly why the financial system that is celebrating records on one end is experiencing a slow-motion consumer financial collapse on the other end that the record-high narrative is deliberately and consistently failing to incorporate. 55 million is not a number this video chose arbitrarily. It is the number derived from the specific intersection of three documented datasets that describe the same financial stress from three different angles simultaneously. The first dataset is Bankrate's 2026 Annual Emergency Savings Report, published February 4th of this year, which found that more than half of Americans are uncomfortable with their emergency savings, that 29% have more credit card debt than emergency savings, and that more than half have the same amount of emergency savings or less than a year ago. Apply that to the approximately 134 million American households, and the number of households in a position of genuine emergency savings inadequacy is in the range of 55 to 70 million. The second data set is the Federal Reserve's G19 Consumer Credit Report released April 7th of 2026, which documented that total outstanding consumer credit, excluding mortgages, has reached $5.12 trillion, with revolving credit hitting $1.33 trillion, and with serious delinquency rates for student loans climbing to between 9.4 and 9.6%, following the full resumption of payment reporting in late 2025. The third data set is the survey data from YouGov, published in advance of their April 21st webinar on what they called the new consumer squeeze, which showed that Americans may look financially stable on the surface, but many are cutting back, leaning on debt, and holding off on investing. These three datasets describe the same population from three angles: insufficient emergency savings, rising consumer debt at record interest rates, and behavioral evidence of spending cutbacks and financial stress. The intersection of those three populations is approximately 55 million Americans who are not experiencing the stock market's record high as prosperity. They are experiencing it as a relevant background noise to the more immediate reality of their monthly cash flow, not covering their monthly expenses. The specific mechanism that is driving the 55 million accounts towards zero this week is not a single event. It is the compounding convergence of five financial pressures that have been building simultaneously since the Iran war began in late February, and that are reaching their most acute phase in the first week of May. The first pressure is gasoline prices. With oil at $105 per barrel Monday morning and crude futures rising on the Iran Project Freedom escalation, national average gasoline prices have crossed above $4.50 per gallon, according to the most recent Gas Buddy tracking data. At the Department of Transportation's estimate of 12,000 miles per year per licensed driver and an average fuel economy of 28 miles per gallon, a $1 increase in gasoline prices costs the average American driver approximately $428 per year, or $35.70 per month. For a family with 2 cars and 2 drivers, the Iran war's oil shock has added approximately $60 to $70 per month in gasoline costs compared to pre-war prices. $60 to $70 per month on a median household income where 46% of credit card holders are already carrying a balance is not a minor inconvenience. It is the difference between breaking even and accumulating debt. The second pressure is credit card interest. The Federal Reserve's higher for longer rate strategy, confirmed by this week's FOMC meeting where 3 of the 12 voting members explicitly opposed even the language of future easing, has kept the federal funds rate at 3.5 to 3.75%. At that rate level, credit card annual percentage rates have reached an eye-watering average of 21 to 24%, confirmed by the G19 Consumer Credit Report published April 7th. The approximately $1.33 trillion in revolving consumer credit outstanding is accumulating interest at those rates, while the consumers who hold those balances are, according to Bankrate's survey data, not primarily focused on paying it down. Their number one financial goal for 2026 is paying down debt. But the operational reality is that 46% of credit card holders are carrying a balance. And for a significant share of those cardholders, the minimum payment does not cover the interest accumulation, meaning the balance is growing automatically every month, regardless of whether they use the card again. The debt trap of a 22% credit card rate in an environment where wages are not keeping up with 3.3% inflation is the specific mechanism that is draining the savings accounts of the 55 million. The third pressure is the student loan resumption. Following the full resumption of payment reporting in late 2025, serious delinquency rates for student loans climbed to between 9.4 and 9.6%. The total outstanding federal student loan balance is approximately $1.6 to $1.7 trillion. The delinquency rate means that approximately $150 to $160 billion of that balance is seriously past due, representing millions of borrowers who are not making their payments and whose financial profiles show the specific characteristics of consumers who have been forced to choose between student loan payments and other essential expenses. For these borrowers, the resumption of payment reporting did not come with new income. It came with an additional monthly obligation layered on top of the existing budget that was already stretched by inflation, gasoline costs, and credit card interest. The result is visible in the delinquency rates. Millions of borrowers are simply not making payments because they cannot. The fourth pressure is grocery and food costs. The Iran war's oil shock has transmitted directly into food prices through the same supply chain mechanism this channel documented in the blockade blueprint analysis. Fertilizer is 20 to 30% derived from Persian Gulf exports that transit the Strait of Hormuz. When fertilizer export costs rise, farm input costs rise, and grocery prices follow with a lag of weeks to months. The most current available data on grocery price inflation shows food at home costs continuing to run above the general CPI rate, with specific categories like fresh produce, dairy, and processed foods showing accelerating increases consistent with the energy and agricultural input cost transmission that the Iran war has set in motion. For a family spending $500 per month on groceries, a 5% increase in food at home costs is $25 per month of additional essential spending with no discretionary alternative. You cannot buy less food than your family needs to eat. The fifth pressure is the housing cost trap. Mortgage rates remain above 6.5% for a 30-year fixed mortgage, reflecting the Federal Reserve's higher for longer rate policy and the term premium increases that are occurring as the Treasury market absorbs $2 trillion in annual deficit financing. Rent prices continue to rise in most metropolitan markets because the housing supply shortfall this channel documented in its home ownership analysis remains unresolved. The combination of unaffordable home ownership and rising rent is producing a specific financial outcome for the 55 million households at the intersection of the three data sets. Their largest monthly expense, housing, is consuming a historically high share of their income, leaving less available for every other spending category, including the emergency savings that Bankrate's data confirms more than half of Americans are uncomfortable with. If you are watching this video and understanding for the first time the specific convergence of pressures that the 55 million Americans quietly emptying their accounts are navigating simultaneously, subscribe right now. Hit the notification bell. Because the historical record of what happens to the broader economy when consumer financial stress reaches this level of concentration and breadth is the pattern that the record stock market high is most dangerously obscuring. The first historical proof is the consumer financial stress pattern of 2007 and 2008, which preceded the financial crisis, and which is the most complete historical demonstration of how consumer financial exhaustion becomes the transmission mechanism that converts investment market stress into broad economic recession. In 2007, consumer financial stress was concentrated in the subprime mortgage borrower population, a specific demographic who had taken on mortgage debt they could not service when interest rates normalized. The mainstream narrative in 2007, echoed in financial media at the same time that bank stocks were reporting strong earnings, was that the stress was contained to subprime borrowers and it would not transmit broadly to the consumer economy. The transmission mechanism that proved that narrative wrong was not dramatic. It was the slow, systematic depletion of household savings and the accumulation of consumer debt by a large enough share of the population that discretionary spending contracted, retail sales fell, and corporate earnings that depended on consumer spending began to miss estimates. The consumer financial stress of 2007 did not cause the financial crisis, but it was the pre-existing condition that made the economy unable to absorb the financial shock when it arrived. In 2026, 54% of Americans say their financial situation is worse than a year ago, the highest reading on record. That is not a contained population. That is more than half the country. Check. Verified, undeniable. The second historical proof is the consumer credit and savings data pattern from the stagflationary period of the 1970s, which is the most complete historical demonstration of how the combination of inflation above wage growth and rising interest rates on consumer debt creates the specific consumer financial trap that this video's 55 million figure describes. In the 1970s, American households that had been built on the assumption of cheap energy and low interest rates found themselves in a world where gasoline prices had quadrupled, mortgage rates were rising sharply, and the real purchasing power of their wages was declining faster than their nominal wages were rising. Consumer savings rates, which had been relatively healthy through the 1960s, fell sharply as households used savings to maintain their standard of living in the face of inflation that was eroding their purchasing power faster than they could replenish it. The precise mechanism was this. Inflation raises the cost of essentials. Wages rise more slowly than inflation. The gap is initially covered by reducing discretionary spending, then by drawing down savings, then by accumulating consumer debt, and eventually by reducing essential spending, which produces the economic contraction that turns the inflation problem into a stagflationary recession. The 5 pressures this video documented, gasoline, credit card interest, student loans, groceries, and housing, are each operating on the 55 million at exactly this stage of the 1970s mechanism. They are past the discretionary spending reduction. They are in the savings depletion phase. And the accumulating consumer credit balance of $5.12 trillion confirms that a significant share are also in the debt accumulation phase. Check, verified, undeniable. The third historical proof is the specific pattern documented in the post-COVID inflation surge of 2021 through 2022, when the Federal Reserve's determination that inflation was transitory allowed the consumer financial stress to build for longer than it would have if policy had responded more aggressively earlier. In 2021, consumer savings rates that had spiked during the COVID lockdowns began to normalize as stimulus payments were spent. By the middle of 2022, the excess savings buffer that American households had accumulated during the pandemic had been almost entirely depleted for the bottom 60% of income earners. The depletion of the pandemic savings buffer was followed by the accumulation of credit card debt at the fastest pace in decades, as households that had been cushioned by stimulus were exposed for the first time to the full impact of 7 to 9% inflation on their monthly budgets. The pattern from 2021 to 2022 is the direct precedent for what is happening in 2026, an initial period of apparent consumer resilience, driven by savings buffers and strong employment, followed by the gradual depletion of those buffers as inflation persists, followed by the accumulation of consumer debt as the emergency savings are exhausted, followed by the beginning of the consumption contraction that precedes broader economic slowdown, the G. 19 data showing consumer debt at $5.12 trillion with revolving credit at $1.33 trillion, and bank rates data showing more than half of Americans have the same or less emergency savings than a year ago, is the consumption contraction phase beginning to visibly manifest in the data. Check, verified, undeniable. Now let us apply this framework to the specific bifurcation that the current economy presents, because it is the bifurcation that makes the 55 million invisible to the record high market narrative, and that is the most dangerous feature of the current economic moment. The Federal Reserve's G19 report described the current American economy as bifurcated. The top tier of earners continues to benefit from record household wealth, with the stock market at all-time highs providing paper wealth gains to the roughly 55 to 60% of Americans who have meaningful equity market exposure, while lower and middle-income families are showing signs of severe financial exhaustion, with credit card and student loan delinquencies reaching levels not seen in years. The bifurcation means that the aggregate economic statistics, total household wealth at record highs due to stock and housing price appreciation, conceal the specific distributional reality that the bottom 40% of income earners have no meaningful stock market exposure, and therefore receive no benefit from the S&P 500's record close, while bearing the full impact of the $4.50 gasoline prices, the 22% credit card rates, the resumed student loan payments, the rising grocery bills, and the unaffordable housing costs that are draining their accounts this week. The specific implication for the stock market at record highs is that the consumer spending that drives approximately 70% of United States GDP is concentrated in the population experiencing the bifurcation's negative side. Small businesses that serve the bottom 60% of income earners, restaurants, discount retailers, personal services, regional banks, and local service providers are operating in an economy where their customer base is increasingly financially exhausted. The NFIB Small Business Optimism Index, which fell in March as oil prices surged and uncertainty about the Iran war's economic impact weighed on business owners' forward planning, is the leading indicator of this transmission. Small business sentiment turns negative before the GDP data shows contraction, because small businesses feel the consumer financial stress in their daily revenue before it appears in quarterly economic statistics. The first Chicago PMI contraction reading of 2026, documented in this channel's Monday Trap analysis, may be the leading edge of this transmission becoming visible in the hard data. The specific population of 55 million who are quietly emptying their accounts this week is not a homogeneous demographic. It includes the working families in post-industrial communities like LaGrange, Georgia, where the community bank that failed Friday night served local depositors, whose account emptying reflects not panic, but the systematic necessity of covering expenses that have exceeded their income for months. It includes the student loan borrowers whose 9.4 to 9.6% serious delinquency rate reflects not irresponsibility, but the mathematical impossibility of servicing post-pandemic debt at 2026 interest rates on pre-pandemic income levels. It includes the small business owners whose operating cash accounts at whatever community or regional bank serves their local market are being drawn down, not because business has collapsed, but because the margins on every product and service they sell have been compressed by the oil-driven input cost inflation that has yet to be passed fully through to their prices. And it includes the retirement age Americans, for whom the bank rate data on emergency savings inadequacy is not a short-term management challenge, but a permanent structural condition that the stock market's record high does nothing to address because they are not and have never been meaningfully invested in equities. Here is the synthesis that connects the 55 million to every other analysis this channel has produced about the current economic environment. The consumer financial stress documented in the G19 report, the Bank Rate Emergency Savings Survey, and the YouGov consumer squeeze data is not a separate phenomenon from the banking system, stress documented in the FDIC's problem bank list, and the weekend seizure of Community Bank and Trust West Georgia. They are the same phenomenon observed at different points in the transmission chain. The consumers whose credit card delinquencies are rising in low-income zip codes above 20% are the same consumers whose community bank loans are becoming non-performing. The community bank loans that are becoming non-performing are the same assets that are producing the unrealized losses on bank balance sheets. The unrealized losses on bank balance sheets are the same dynamic that the FDIC's 60 problem banks are being watched for, and the community bank failures that result from those unrealized and realized losses are the weekend seizures that this channel documented 2 days ago in LaGrange, Georgia. The consumer financial collapse and the banking system stress are the same crisis, observed from the bottom up and the top down simultaneously. The stock market at record highs is the middle of the picture that the top-down investors are looking at, while the bottom-up reality of 55 million Americans quietly emptying their accounts this week is the foundation on which every record-high valuation ultimately rests. Subscribe to this channel, share this video, because the 55 million Americans quietly emptying their accounts this week are not a footnote to the financial story of 2026. They are the story. The record high is the headline. The empty accounts are the foundation. And when the foundation weakens enough, the headline always follows. Let me give you the analytical layer that makes the 55 million figure not just emotionally resonant, but mechanically important for every investor watching this video, regardless of their personal financial situation. Because the 55 million who are emptying their accounts are not simply a social concern. They are a macroeconomic leading indicator, and understanding what they predict about the trajectory of the United States economy over the next 6 to 12 months is the most important investment signal currently available in the consumer spending data. Consumer spending represents approximately 70% of United States GDP. When the consumers who drive that spending shift from net savers to net die savers, from using income to build savings, to drawing down savings to cover expenses, the aggregate consumption that GDP measures continues at roughly the same level for a period of time while the underlying financing mechanism transitions from income-supported to debt-supported. This transition is visible in the G19 data. Revolving credit at $1.33 trillion is the debt-supported consumption phase. The consumers are still spending at roughly similar levels, which is why the GDP data for the first quarter of 2026 showed growth of 2% annualized. But they are increasingly financing that spending with credit cards at 21 to 24% annual interest rather than with income, because their income is not keeping pace with inflation. This debt-supported consumption phase has a specific and documented duration limit. When the credit card utilization rate approaches the available credit limit, when the minimum payment absorbs too large a share of the monthly budget, or when a financial shock, a job loss, a medical expense, a car repair, creates an unmanageable spike in necessary spending, the debt-supported consumption phase ends, And when it ends quickly, as the consumer simultaneously stops spending on discretionary items and reduces spending on essentials to the minimum necessary to service debt. That transition from debt-supported consumption to consumption contraction is the leading edge of the economic recession that the Moody's model is currently placing at 49% probability. The specific timeline of the consumer financial stress transmission to GDP is documented in the research on prior consumer credit cycles. From the point where revolving credit growth starts decelerating and delinquency rates begin rising, which the G19 data confirms is the current moment, the typical lag to GDP contraction is 2 to 4 quarters. The G19 data covers the period through February 2026. 2 to 4 quarters forward from February puts the potential GDP contraction signal in the range of August 2026 to February 2027. This is the specific timeline that the Goldman Sachs bear case, the Moody's recession model, and the IMF's shadow of war adverse scenario all cluster around. A second half of 2026 economic deterioration that the first quarter's 2% GDP growth does not yet show. The 55 million who are emptying their accounts this week are the leading indicator for that second half deterioration. They are 3 to 6 months ahead of the GDP data, and they are telling the GDP data through their behavior what it will say next. The bifurcation that the Federal Reserve's G19 report documented between the top tier of earners and lower and middle income families has a specific investment implication for the S&P 500's record high. The index is dominated by companies that serve the top tier of earners or that operate in sectors, technology, financial services, healthcare, energy, that generate revenue from capital flows rather than from consumer spending by the bottom 60% of income earners. Apple, Nvidia, Microsoft, Alphabet, Amazon, and Meta collectively represent over 30% of the index. Their revenues are derived from enterprise software, cloud computing, digital advertising, and device sales that are concentrated in the higher income population and in corporate customers who are not among the 55 million emptying their accounts. This concentration means that the S&P 500's earnings can remain relatively strong, even as consumer financial stress at the bottom 60% of the income distribution is acute and worsening, because those earnings are not primarily dependent on the bottom 60%'s spending. But this sectoral insulation has a specific limit that the current environment is approaching. The consumer spending contraction at the bottom 60% of income earners does not stay contained to that population's direct purchases. It transmits through the economy via small businesses that serve those consumers, regional banks that lend to those businesses, commercial real estate that houses those businesses, and the tax revenues that fund the government programs that provide the safety net for those families when they can no longer service their own expenses. The transmission chain from 55 million emptying accounts to commercial real estate stress at regional banks to the FDIC problem bank list is the chain this channel has documented across its entire analysis of the current crisis. The 55 million are the beginning of that chain. The 2 bank failures of 2026 are a downstream manifestation of it. The 60 banks on the FDIC problem list are the next segment of the chain. And the potential Goldman Sachs bear case S&P 500 decline to 5,400 is the endpoint of the chain if it completes its transmission without a significant reversal in either the oil price trajectory, the Federal Reserve's policy stance, or the consumer income growth rate. The specific week of May 4th through 8th of 2026 adds one more dimension to the 55 million story that connects consumer financial stress to the specific data releases that will set the market's trajectory for the coming weeks. The ISM Services PMI for April will be released Tuesday, May 5th. The services sector, which employs approximately 80% of American workers and which is the direct economic environment of the 55 million, will show whether the consumer financial stress documented in the G19 report has begun to translate into reduced services spending. In March of 2026, the ISM Services Employment Index plunged 6.6 points to 45.2, its lowest since December 2023, while the Services Prices Index spiked to 70.7, the highest since October 2022. A services index below 50 in April would confirm that the consumer spending contraction has begun. A prices index above 70 would confirm that the stagflationary combination is intensifying. Both together would be the data that the 3 hawkish FOMC dissenters are citing as evidence that a rate hike is warranted and that the S&P 500 at record highs has not adequately priced. The JOLTS job openings data for March, released simultaneously with the ISM Services on Tuesday, will provide the labor market context for interpreting the jobs picture. The April jobs report that came in at 177,000 on Friday was stronger than expected. But the JOLTS data will show whether that strength reflects genuine hiring or the statistical artifact of certain sectors adding jobs while others shed them, as the Chicago PMI's first contraction reading of the year suggests manufacturing is already doing. The combination of the ISM Services PMI, the JOLTS data, and the continuing earnings releases from AMD, Disney, and the other major companies reporting this week will collectively determine whether the narrative that drove Friday's record close, strong earnings, plus peace hopes, plus taco trade momentum, survives contact with the economic reality that 55 million emptying accounts are already describing. Here is the final observation that connects the 55 million to every investor watching this video, regardless of their own financial position. The 55 million are not an abstraction. They are the employees, customers, neighbors, and family members of every American who is watching the S&P 500's record high and feeling prosperous. Their financial stress is not separated from the broader economy by a clean wall that keeps their distress on one side and the market's record valuations on the other. It transmits through the supply chains, the credit markets, the small business ecosystem, and the consumer spending patterns that ultimately generate the corporate earnings that the record market valuation is built upon. The Federal Reserve's G19 report called it bifurcated. The more accurate description is fragmented, a surface of record high wealth concentrated at the top of the income distribution, supported by a foundation of $5.12 trillion in consumer debt, 22% credit card rates, 9.4% student loan delinquencies, and 54% of Americans saying their financial situation is worse than a year ago, the highest reading on record. Foundations do not fail all at once. They fail gradually, then suddenly. And the 55 million who are quietly emptying their accounts this week are the gradual phase of a failure that will become sudden only after everyone who should have been paying attention has spent too long looking at the record high instead. Subscribe to this channel. Share this video with every person you know who sees the S&P 500's Friday close and believes that number tells the full story of the American economy in May of 2026. It does not. The full story is in the 55 million. And understanding that story is the difference between investing in a narrative and understanding the economy beneath it. One more thread must be pulled to complete this analysis. The 55 million who are quietly emptying their accounts this week exist in a specific relationship with the two bank failures. This channel documented in its weekend seizure video, and that relationship reveals the most important systemic connection in the current financial picture. Community Bank and Trust West Georgia, which failed on Friday night with $27 million in uninsured deposits, was a community bank in LaGrange, Georgia, serving a local commercial and residential customer base. Its failure, like Metropolitan Capital Bank's failure in Chicago in January, reflects the specific financial stress of the communities those banks served. Banks that serve financially stressed communities experience elevated loan delinquencies, declining deposit balances as customers draw down savings to cover expenses, and rising credit losses on commercial real estate loans secured by properties whose tenants are themselves financially stressed businesses, serving financially stressed consumers. The 55 million emptying their accounts are the depositor base and the loan customers of the 60 banks on the FDIC's confidential problem list. Their financial stress and the banking system's stress are not two separate phenomena. They are one phenomenon observed at 2 points in the same chain. The specific concern for the second half of 2026 is whether the consumer financial stress visible in the current data, the 54% worst situation record, the $5.12 trillion in consumer debt, the rising delinquency rates, reaches a level of severity that accelerates the bank loan losses at the 60 problem institutions from manageable quarterly deterioration to acute resolution requiring failure. The FDIC's problem bank list grew by 3 institutions in the most recent quarter. At that pace of growth, the list could reach 70 to 80 institutions by year end. At a higher pace of growth, consistent with the transmission of consumer financial stress through commercial real estate loans in the communities most economically stressed by the oil shock and the Iran war's economic damage, the list could grow faster. The FDIC's Deputy Director of the Division of Insurance and Research has not published updated trajectory language since the most recent quarterly report, but the G19 consumer credit data, published April 7th, is the forward-looking indicator that the FDIC's problem bank trajectory depends on. Consumer delinquencies lead bank loan delinquencies by 1 to 2 quarters. The consumer delinquency data is already alarming. The bank loan delinquency data that will emerge from it is still forming. This is the complete picture that the record S&P 500 is not telling. The 55 million emptying their accounts this week are not invisible to the data. They are visible in the G19 Consumer Credit Report, in the Bank Rate Emergency Savings Survey, in the YouGov Consumer Squeeze data, and in the FDIC's problem bank trajectories that derive from their financial behavior. They are invisible to the record high narrative because the record high narrative is constructed from the financial performance of the top tier of the income distribution and the top tier of the equity market, both of which are genuinely performing strongly, genuinely setting records, genuinely generating revenue and earnings that justify the attention they receive. But the foundation beneath the record high is 55 million Americans quietly emptying their accounts. Foundations that are being emptied do not support records indefinitely. Subscribe to this channel. Share this video. The 55 million are the story. The record high is the distraction. And the investors who understand the difference are the ones who will be positioned correctly when the foundation's condition becomes visible in the same headlines that currently exist only to celebrate the record.